Could Bitcoin soon sit alongside bonds and cash in state treasuries? Texas and New Hampshire are asking that question, and the answers could reshape public finance. Here's the context. States constantly stress test their portfolios to protect taxpayers and essential services. Inflation came roaring back in recent years, and market swings reminded officials how correlated many assets can be. Against that backdrop, Bitcoin is getting a fresh look as a potential diversifier with different drivers. Supporters point to 3 design features. The supply is capped at 21 million, so dilution is limited by code. New issuance halves on a known schedule roughly every 4 years, which makes long-term supply more predictable. And the network settles transactions in a steady cadence, about every 10 minutes, on a ledger anyone can audit. Those traits speak directly to scarcity, transparency, and settlement rhythm, which are the mechanics treasurers analyze when they consider stores of value and liquidity. What changed versus a few years ago is also important. Institutional plumbing has matured, with professional custody, audit, and compliance options that give officials clearer operating playbooks. Inflation's resurgence elevated diversification reviews to the policy front burner. Legislative exploration in Texas and feasibility discussions in New Hampshire moved the topic from theory to agenda. And accounting guidance on impairment and fair value has advanced, improving how digital assets show up in financial statements. The implications could be meaningful even if allocations are small. Limited, rules-based exposure by a few states would likely accelerate standardization in accounting, custody, and risk controls. That, in turn, could shape how pensions, endowments, and other public entities measure and report digital asset risk. Markets may respond with deeper liquidity and more robust service providers, while also pricing in policy and regulatory developments more quickly. Risks remain front and center. Price volatility can be acute over short horizons. Governance and operational questions require clear policies, from key management to vendor oversight. Regulatory and accounting shifts can change reported results. Liquidity planning and drawdown tolerance must be defined in advance. Policymakers weighing these factors are bringing the debate into the mainstream of public finance. For investors, the takeaway is simple. Watch the policy process, not the headlines. Frameworks, controls, and accounting rules will determine how sustainable any exposure becomes, and those same guardrails often filter into private portfolios. Read the full article at finlitica.com.